Good afternoon, viewers. This is CPH House Cafe again, and today we are proceeding with our series of financial reporting. In the last seller video, we talked about the IS 41, that was agriculture, and today we are going to look at something, as I had promised you, that it is IS 21. IS2, sorry, that is inventory. And this inventory, basically we've been talking about certain scenarios of how we get some of this inventory, because even when we looked at the IS 41, we've seen some items that are going to be treated as inventory, as the agricultural produce after the point of harvest. But before or due to harvest, they are under IS 41. So basically, when you are looking at the IS2, the scope for it is basically handling 3 items, or we have stock is categorized into 3 items. One, we have the finished goods, as we are going to be seeing them. Let me try to increase a bit. As we are going to be seeing them, maybe I put it to 20 so that you can be able to see my screen. Yeah, just this one. Okay, hope you can be able to see. Here we are saying that the inventory is basically subdivided into 3. We have the finished goods, we have the work in progress, that is the unfinished products that are still in the production process. Then we have the raw materials themselves we use in the production. So when you are talking about the inventory, we have two companies. We have the company that is just a startup. It is buying stock, finished produce, and it sells it. Basically, it deals in purchases. But there are other companies that are already in the market that are producing their own products. Those are the ones that are called the manufacturing companies. I hope you did those ones in financial accounting, where we are doing the manufacturing accounts and all that. So that's basically what we are going to pick some of the concepts. Hope you can be able to remember those ones. If you don't remember, you can go and check to my video on cost accounting, because I created some of them there. You may find some of the costs we are going to be talking about here. So when we proceed to, that's basically the scope of IS2. Or basically, what are we going to be looking at when you're talking about IS2 inventory? So, what are some of the items that are not included within the IS2? We said one is agricultural produce at the point of harvest. We looked at that one under agriculture, and we said that one, agricultural produce at the point of harvest, or before the harvesting. That is treated under IS 41 agriculture. Then we have a work in progress under long-term contracts. Yes, we may have unfinished work, but if they are in contract, it means that will be accounted for under IFRS 15, that is living from contracts with customers. So we have another one with these financial instruments. Financial instruments, we are talking about the debentures, bonds, shares, and all other traded instruments as you know them. Those are accounted for under IFRS 9, that is financial instruments. So basically what we are going to be looking at when we are talking about the inventory, that's how basically we recognize it. Must be finished goods, must be work in progress, but not the one for long-term contracts. then it must be raw materials. So having known that we have identified them, then which values are we going to attach on those items we have got? That is the measurement of inventory. And we are saying initially we measure inventory at cost, but the word cost is very broad. We spoke about it when we are handling IS 16, that was PPE, because it was also initially measured at cost. Most of these things we've been saying, except the biological assets, we've seen that some of them are accounted for initially at cost, or we use the cost model for initial recognition or for initial measurement. But when we are talking about the cost, the word cost is very broad, to the extent that, as we said, we have a company that is engaged in production of goods and services. There is also a company which is engaged in buying stock and selling it. So they are going to be accounting those items separately. The one which is into buying is going to compute the cost of purchase. And the cost of purchase, we said it doesn't include only the purchase price only. We said it is purchase price with less trade discounts or rebates if they are there. We add the other import duty and other direct taxes that are associated with the asset. Then we also include the other relevant costs that are related or that are attributable to the product we are purchasing. So long as they are associated with the asset, and before we incur them, they are inevitable. If you don't incur them, we are not going to be having the stock we want. Whether it is whether we are getting raw materials, whether it is even work in progress. If I may talk about the work in progress in the sense that if the production has stopped, but there are some items that are still in the process, and we are supposed to keep those unfinished items, so we are supposed to incur costs, storage costs. We store those items, the unfinished items, before the production resumes. So when the production resumes, at least we pick those items where we stocked them, and we start reproducing them, or we complete the process. So that storage cost we incur on work in progress. I'm not talking about the storage cost we incur in storing raw materials. Of course, that one we are going to see under the costs that are not associated within our stock. Then the other one is, if you're not purchasing, it means you are making your own products. So you will be incurring what we call the cost of conversion. Cost of conversion excludes only the cost of raw material. But conversion costs, those are costs of converting the raw materials into finished goods. All the costs that are directly attributable to the cost, they are supposed to be accumulated at once and added to the cost of the raw materials. So if you are producing your own products, you get any direct and indirect costs that are directly attributed to the production. As you do your manufacturing accounts, you know how to do that. Getting the prime cost, you add other factory costs that are directly attributed to the production, then you'll be able to get the cost of production. That's what we are talking about. By the time you reach the cost of production, that's what we are meaning. So let's look at what are some of the costs that are not part of the inventory. Of course, I made this one big. Let me reduce a bit, because I wanted you to get full picture of it. seems to be small. When I reduce that, then let me increase only the part we want. Okay, hope you can be able to see them, the costs that do not form part of the cost of inventory. Whether you are selling, whether you are producing, one, we have the selling costs. Of course, by the time you incur the selling cost, you have already determined the cost of the cost of goods you are going to sell, because you can't sell what you have not produced. So by the time you reach the selling price, it means you have already manufactured the products. So we don't include that. Secondly, the abnormal amount of wasted materials and labor. These ones are basically the unexpected things. They were not normal losses or that were incurred in the process, but these were just as a result of maybe misuse or mishandling of the materials, or over staffing, all that. The cost that those costs we incur, they are not supposed to be part. Then we have the storage cost. Storage cost is only relevant to the extent that it is part of the production. That certain items, if the production process has, let's say, 5 departments, and each department works or operates on a certain product to a certain extent, you may find that you need to store some of the produced particles before they go to the next stage. That storage cost is supposed to be included, but the one we incur, the general one, is not. Storage cost is only to the extent that it is part of the production. If you don't incur that, then production cannot exceed or cannot take place. Then the other one are the administrative costs that are not directly attributed to the costs. Selling and distribution, those ones, they are not part of the way you do your manufacturing. So long as you get the cost of production, that's where we stop. We don't go up to the production cost, the total production cost. So I've got some of how we determine the cost. It is here. Leave alone this NRV. We are going to talk about it subsequently when we are reporting. But the cost, we say the cost includes the cost incurred in bringing the inventory to its present working condition and location. Then, meaning this is going to be the transport. Then the cost of the material itself, the labor we are putting in. Of course, when you bring the materials, you need people to operate on. You need direct expenses, like you can hire cranes to lift those raw materials and take them to where they are supposed to be processed from. So all that, you accumulate it, you get the prime cost, then you add other manufacturing overheads. But those manufacturing overheads, they must be based on the normal output, what we have produced out, not these abnormal losses we've incurred. So that's how basically we can determine the cost. Then we try to look at how are we accounting for inventory subsequently at the reporting date. We say that the reporting date we measure inventory at the lower of the two. Which one and which one? The lower of the cost and the net realizable value. When you're talking about the net realizable value, the formula for it, the general one, it's what I gave here. That to get the net realizable value, you get the selling price less cost of completion and cost of sale. But here, since we are looking at the cost, which cost are we going to attach on the items? This one we exclude it because it is like it's what we are going to be taking. So we only take the expected selling price minus the cost to sell. any point of sale you've incurred certain costs when you're selling the items, you remove. And maybe to conclude by this one, you can say that this net realizable value, it's like what you're supposed to get from the market less what you have incurred to get that amount you're supposed to get. Then that's what you can really realize. It is the expected selling price minus the cost to sell. When you get that, the lesser of the two, what are we taking to our financials is the lesser of the two. If the cost is less than the net realizable value, we take the cost. If the net realizable value is less than the cost, then we take the net realizable value. But how do we deal with the difference? Then those are the things we are going to be seeing down here. Maybe we'll first look at what are some of the scenarios that may cause, if you're talking that the NRV is going to be less, if let's say it happens and the NRV is less than the cost, what may cause that? What may lead to someone to sell goods at a low cost than what they are actually incurred? One, it may be a marketing tool. You find that the company wants to increase their market. When they are increasing their market, it means they are going to be selling at lower prices to capture the market. Secondly, we can talk about if maybe they made some errors when they are doing their costing. Of course, when you have made an error, it doesn't mean that you are going to shift all the burden to the client, because for you have made an error when you are doing your costing, and maybe you overstated your stock and you can't get that money from the market. Maybe you did not look at some of the factors when you are buying stock, and you bought the stock expensively. But when you got the market and you are getting less money, it doesn't mean that you are supposed to force people to buy expensively because you incurred more costs. You go with the market, and we said that what is in the market is fair. There is no cheating there, because the prices are determined by forces of demand, what people want and what you can supply. The other one is maybe physical deterioration. The item has expired. Of course, something, even if it is not expired, when it is about to expire, you sell it cheaply so that it gets off the market. Maybe these people who are selling like the items which are fresh. You reach at a point things are going to go bad, you just say, you know what, just give me this amount and we shall resume business later. Because at the end of the day, instead of losing all of it, you rather get cheap or small amount, then you compensate when the days are good. Then the other one may be that even the market prices, you may find the market prices, they have increased or they have reduced. You bought the things, it wasn't out of the errors that during your costing you made errors, but as we said, the market conditions, they keep on changing. You can get a higher value or a lower value. So when they have reduced and your costs are high, of course you end up selling what is prevailing in the market. The other one, we can talk about the obsolescence, and we say this is when things are going to be outdated, there are some technological advancements and people are no longer using some of the items. You end up selling them less than what you actually paid. So those are basically some of the things that may lead to NRV being less than the costs we've incurred. So how do we deal with those things, that difference? If you are selling less than the cost, we treat that loss as an expense in the income statement. We expense it. If let's say you bought stock at 10 million and now what you can only get from the market is 8 million, that difference of 2 million is supposed to be listed as an expense. That's how basically we do it, using the prudence concept. Of course, you can't expect now someone will ask, what if the cost was 20 million, was 10 and I got 12? Of course that you've made a profit. But we are now talking about the other worst scenario, when you are selling less than the cost. It is the one which is important. The other one is okay, it's what we want, but this negative idea, that's basically what we are talking about here, the recognition of the expense. How do we recognize inventory as an expense? We recognize inventory as an expense like the way I said, that inventory, we bought it at 10 million and now we can get only 8 million. It's like our inventory is going to be reducing in value, because that cost is actually the cost of the inventory. It's not about any profit. You have actually sold less than what you are supposed to. It's like the inventory, they are reducing, assets are reducing. And remember, we said when we are recording, we recorded the lesser of the two. So we were supposed to go with the 8 million, what we got from the market. But what about the 2 million that is there as a difference? You treat it as an expense. Of course, when you treat it as an expense, it means that even your profits are going to be less by that 2 million. So by default, that in the assets, under current assets inventory, we reduced it by 2 million. It will also be compensated in the equity section for the balance sheet to balance, in the equity section, whereby when we are taking our net profit, it will be less by 2 million. That's basically how we do the accounting. So don't tell me that since these items are reducing in value, you know, we said a reduction in assets means a liability, sorry, an expense, and you want to take it to anyway, and the bank statement, surely in the balance sheet. No, you don't take it, it's already reduced by the net profit. Of course, the net profit we shall take there will be less by that, so it will make the balance sheet to balance. So how do we record the other option of recording inventory as an expense? Is one, if let's say you have acquired asset of 10 million, but now you've got a revenue of 15 million, what do you do with the 10 million? We treat that 10 million as if it was an expense. We less it from the money we got. That's basically what we do. When we get our sales and we less cost of sales, that cost of sales becomes an expense because we are lessing it from the sales. There are two ways. One is when the inventory is losing value. Secondly, when the inventory has been sold and we've got the money. That money we've got, we treat the cost of the inventory as an expense and we less it to get our gross profit. Hope you can be able to analyze that and you understand. The trial question, the trial number is, this is the November 2017 question 5. We shall look at that in the due course. Our next video is going to be about the borrowing costs. We want to look at how are we going to be accounting for the loans we get, and we buy assets, or we use them in investments. How do we do that in the next video? So I want you guys to subscribe to the channel and be able to share, comment. You can also advise on things you see that they are not going as the way you want them to be. You can also put them in the comment. We shall be able to interact and have more understanding of these concepts and be able to pass these papers with ease. Thank you.